You want money, not just pay the bills money, real money. The kind that makes you stop checking prices at the grocery store. The kind where a flight delay is annoying, not a financial emergency. Everyone wants that. Almost nobody gets it. And here's the thing, it's not because they're lazy, it's not because they're stupid, it's because nobody ever explained one concept to them, one rule, one mathematical trick that's been hiding in plain sight for centuries. I'm Ape, and today we're talking about why most people will never build real wealth and the embarrassingly simple fix that changes everything. Let's go.
Most people have the same relationship with money. Money comes in, money goes out. Repeat until retirement. Hope it works out. This is called living paycheck to paycheck, and it's not just a broke person problem. Studies consistently show that a significant portion of people earning six figures still feel financially stressed. High income, zero wealth. Income and wealth are not the same thing. Income is what you earn. Wealth is what you keep and what your money earns on top of that. The paycheck loop keeps people rich in lifestyle and broke in assets. New phone every year, subscriptions stacking up, nice apartment, zero investments. Ape has seen this pattern. It's very human. Okay, so what's actually going on? Here's a latte. Cost $6. Not important on its own. A $6 latte is fine. Life is short. Drink the latte. But let's use this latte as our running example today, because the latte isn't the problem. What the latte represents is. Every dollar you spend is a dollar that cannot grow. That sounds obvious. It's not obvious when you feel it in real life. When you spend $6, you don't think, I just gave up future wealth. You think, I needed coffee. The issue isn't the coffee. The issue is that nobody ever showed you what that $6 could become given enough time. We'll come back to the latte repeatedly.
Here it is, the thing. Compound interest, also called compounding, is when your money earns returns, and then those returns also earn returns. Your gains generate their own gains. It's money, making more money. Albert Einstein may or may not have called it the eighth wonder of the world. That quote is probably fake, but the math behind it, completely real. Here's the basic version. You invest $1,000. It earns 10% in a year. Now you have $1,100. Next year, the 10% applies to $1,100, not $1,000, so you earn $110, not $100. Year 3, 10% on $1,210. You earn $121. The numbers grow bigger every single year, even though you added nothing. That's compounding, and it gets insane fast. Back to the latte. You spend $6 a day on coffee. That's roughly $180 a month, $2,160 a year. Now imagine, instead of spending that $2,160, you invest it every year into a basic index fund, a diversified basket of stocks that historically averages around 7 to 10% annual returns over long periods. Do that for 30 years. You didn't put in millions, you put in lattes. After 30 years, that could grow to somewhere in the range of $200,000 to $300,000, depending on returns, from coffee money. Ape is not saying don't drink coffee. Ape is saying understand the real cost of every dollar you spend. The cost of the latte isn't $6. It's $6 plus everything that $6 could have become. Economists call this opportunity cost. Now you know the term. Here's what makes compounding brutal if you ignore it and magical if you use it. Time. The single most important ingredient in compounding isn't how much money you invest, it's how long that money has to grow. Let's look at two people. Call them Alex and Ben. Alex starts investing $200 a month at age 22, stops at age 32, puts in $24,000 total.
then does nothing for 30 years. Ben starts investing $200 a month at age 32, keeps going until age 62, puts in $72,000 total. Who has more at retirement? Alex, by a lot. Alex started 10 years earlier, put in less money, and ends up with significantly more because their money had more time to compound. 10 years, that's it. That's the gap. This is why financial people sound like broken records when they say, start early. It's not because they're boring, it's because the math is violent. Every year you wait is not just a year lost, it's the compounding of that year lost. So, if compounding is this powerful, why doesn't everyone do it? 3 reasons. 1, it's invisible. When you spend $6 on a latte, the reward is immediate. Coffee, now, happy. When you invest $6, the reward is in 30 years. Invisible, abstract, easy to skip. Our brains are bad at valuing distant rewards. This is called hyperbolic discounting. We dramatically undervalue things that happen far in the future. Psychologists have studied this extensively. The future is always competing with right now, and right now usually wins. 2, the numbers look small at first. If you invest $200 a month and check your account after 6 months, you have $1,200, maybe $1,250 with returns. Underwhelming, feels pointless. People quit here. But compounding isn't linear, it's exponential. The exciting part happens later. The first decade feels like nothing. The second decade feels like something. The third decade changes your life. Most people never get to the third decade because they got bored in the first. 3, nobody taught them. Schools teach algebra, they teach Shakespeare. They do not teach you what a compound interest calculator looks like applied to your own salary. That's a systemic failure, and it's not your fault. But now you know. There's another villain in this story, a sneaky one. Lifestyle inflation. You get a raise. Instead of investing the extra money, you upgrade your lifestyle. Nicer apartment, better car, more lattes, more subscriptions. Your expenses grow exactly as fast as your income. Net wealth, unchanged. This is extremely common. It's why some people earn more in their 30s than they imagined in their 20s and still feel broke. Every raise is an opportunity. Most people use raises to live bigger. Wealthy people use a portion of every raise to invest more. The formula isn't complicated. When your income goes up, your investment amount goes up. Your lifestyle can go up too, just not by the full amount of the raise. Even investing 20% of every raise while spending the other 80% changes your long-term trajectory dramatically. Fair question. The most common answer for beginners, index funds. An index fund is a type of investment that tracks a broad market, like the S&P 500, which represents the 500 largest companies in the US. When you buy an index fund, you're buying a tiny piece of hundreds of companies at once. You don't need to pick stocks, you don't need to follow earnings reports, you don't need to know what a PE ratio is. You just buy the index regularly. This is called dollar cost averaging, meaning you invest a fixed amount on a regular schedule, regardless of market conditions, and let time do the work. Over long historical periods, broad market index funds have averaged around 7 to 10% annual returns. That's not guaranteed. Markets have bad years, but over decades, the trend has been upward. Warren Buffett, arguably the most successful investor in history, has publicly and repeatedly said that most people would be better off just buying a low-cost index fund than trying to pick individual stocks or hire expensive fund managers. When one of the richest humans ever tells you something about investing, it may be worth listening.
Let's upgrade our latte example. You buy a latte every morning, $6, every single weekday. But starting today, you also set up an automatic investment of $200 per month into a basic index fund. Non-negotiable, automatic. Comes out like a bill. You don't touch it, you don't watch it every day, you don't panic when the market drops temporarily, you just leave it. In 10 years, roughly $35,000 to $40,000 depending on returns. In 20 years, roughly $100,000 to $130,000. In 30 years, potentially $250,000 to $400,000. From $200 a month. You kept the lattes, you just added one automatic habit. This isn't exotic finance. This is the most boring, most proven method of building wealth for regular people. The rich person's secret is embarrassingly undramatic.
Here's a quick mental trick. The rule of 72. Divide 72 by your annual interest rate to find out how many years it takes your money to double. At 8% annual return, 72 divided by 8 equals 9 years to double. At 6% annual return, 72 divided by 6 equals 12 years to double. So if you invest $10,000 at 8% returns and leave it alone, year 0, $10,000. Year 9, about $20,000. Year 18, about $40,000. Year 27, about $80,000. You put in $10,000. You walked away with $80,000 without adding a single dollar. That's the rule of 72. Remember it. Compounding works both ways. When you carry debt with high interest, especially credit card debt, which can charge 20% annually, compounding works against you. You spend $1,000 on a credit card at 22% interest and make minimum payments. That $1,000 can take years to pay off. You end up paying $1,400, $1,600, more, in some cases nearly doubling what you originally spent. High-interest debt is like having an investment that compounds aggressively, but in the wrong direction. Every dollar of high-interest debt you pay off is a guaranteed return equal to that interest rate. Paying off a credit card charging 22% is a guaranteed 22% return on that money. No investment consistently does that reliably. Before compounding works for you, eliminate anything that has compounding working against you. Pay off high-interest debt first, then invest. That's the order.
Where you hold your investments affects how much of it you keep. In most countries, there are tax-advantaged investment accounts, accounts where your money grows with reduced or deferred taxes. In the US, these include things like 401ks and IRAs. In the UK, ISAs. In Canada, TFSAs. These names aren't important right now. What matters is that they exist. Using a regular taxable account to invest means paying taxes on your gains annually. Using a tax-advantaged account means letting more of that compounding work uninterrupted. APE recommends finding out what tax-advantaged investment accounts exist in your country and using them. It's one of the few legal ways to keep more of your compounding returns. The government gave you a cheat code. Use it.
Okay, some people reading this are already 35, 40, 45, and they're thinking, I missed it, too late. Not true. Starting later means you need to invest more per month to hit the same target, but the mechanism still works. Compounding at 45 over 20 years still produces dramatically more than a savings account. Someone starting at 40, investing $500 per month at historical average returns could still build hundreds of thousands by 65. Not the same as starting at 22, but vastly better than not starting. The second best time to plant a tree was yesterday. The actual best time is today. The latte isn't going to drink itself.
Wealth is not income. Wealth is assets that compound over time. Compound interest is money earning returns on its returns. Time is the most important variable. Starting early beats investing more. Lifestyle inflation is the silent killer of wealth.
Spend less than you earn, invest the difference. Index funds are the boring, proven vehicle for most people. Invest automatically, on a schedule, regardless of market noise. High-interest debt compounds against you. Kill it first. Use tax-advantaged accounts. They're a legal cheat code. The $6 latte costs you $6 today and potentially hundreds more in foregone future wealth. You don't need to be rich to start. You need to start to eventually be rich. Most people will never build wealth because they never learned one rule, and now you know it.
The fix is not complicated. Spend less than you earn, automate your investments, give it time, don't panic. That's it. The entire wealth building strategy for 95% of people fits in one sentence. The complexity isn't in the method. The complexity is in actually doing it consistently for years while everyone around you is buying things they can't afford to impress people they don't like. You now have the knowledge. The rest is just discipline.
If this video made your coffee feel like a financial decision, that's the point. Hit subscribe. Ape will keep explaining the stuff nobody taught you in school. And hey, if compound interest is so powerful, imagine what happens when this channel compounds your knowledge over time. See you next time.